The global financial architecture is currently approaching a moment of structural insolvency that is being deliberately obscured by the velocity of digital asset inflation and sophisticated market interventions. For the first time in modern economic history, the primary risk to global stability is not a lack of liquidity, but the mathematical certainty that sovereign debt levels have surpassed the capacity of the productive economy to service them. As we navigate through February 12, 2026, the interest expense of major Western nations has officially exceeded their total defense budgets, creating a fiscal death spiral that leaves central banks with only two catastrophic choices: hyperinflate the currency through more money printing or allow a systemic collapse of the banking system. This is the insolvency moment that mainstream media outlets refuse to label, yet every institutional algorithm is already pricing. In a reality where the traditional risk-free government bond has become the most dangerous instrument in a portfolio. This internal erosion of the dollar-based system is accelerating because the United States is currently forced to refinance trillions of dollars of existing debt at interest rates that are triple what they were 5 years ago. This process, known as the debt rollover, is functionally a massive transfer of wealth from taxpayers to creditors, but even this is no longer sufficient to maintain the illusion of solvency. The primary buyers of these bonds, which are foreign central banks, have largely stopped accumulating new debt, forcing the Treasury to rely on domestic banks and the Federal Reserve to absorb the excess supply. This creates an artificial market where the price is not set by supply and demand, but by political necessity. For the average investor, this means that the purchasing power of their savings is being systematically liquidated to pay for the errors of fiscal management, a process that is invisible on a stock market screen, but painfully obvious at the grocery store and the fuel pump. The disconnect between the screen price of financial assets and the real-world cost of living has created a volatile social and economic environment that is ripe for a paradigm shift. While the S&P 500 may continue to hit nominal highs due to the debasement of the currency it is priced in, the real value of these gains, when adjusted for the true rate of inflation, is actually negative for the majority of participants. This is the great illusion of 2026, a booming stock market that masks a collapsing middle class and a hollowed-out industrial base. Institutional capital is quietly moving into hard assets that cannot be printed, such as high-grade industrial land, energy infrastructure, and, most importantly, physical precious metals. This migration is the ultimate vote of no confidence in the fiat currency system, and it is happening with such force that it is beginning to break the pricing mechanisms of the commodities exchanges in London and New York. At the heart of this struggle is the silver market, which has become the primary battleground for the battle between paper derivatives and physical reality. For over half a century, the COMEX has used leveraged short selling to keep the price of silver artificially low, allowing industrial users to source cheap metal and banks to profit from the spread. However, this mechanism requires a constant supply of physical metal in registered vaults to maintain credibility. As of today, the registered silver inventory on the COMEX has dropped to historic lows, reaching a point where there are over 60 paper claims for every single ounce of physical silver held in the vault. This fractional reserve system is nearing its breaking point because industrial demand from the solar, electric vehicle, and semiconductor sectors has reached a structural deficit that no amount of paper trading can satisfy. The industrial demand for silver is no longer a luxury but a strategic necessity for the global energy transition. A single gigawatt of solar capacity requires approximately 40 metric tons of silver, and with the world aiming to install thousands of gigawatts by the end of the decade, the math simply does not work at the current price. We are witnessing a silent short squeeze where major manufacturers are bypassing the traditional exchanges and buying directly from miners at massive premiums to ensure they have the raw materials to keep their factories running. This has created a two-tiered market consisting of the fake spot price on the screen and the real street price that is often 25% higher. When the COMEX is finally forced to declare a failure to deliver, the price of silver will not just rise, but it will undergo a violent reset to reflect its true scarcity in a hyper-technological world. Simultaneously, the geopolitical landscape is shifting toward a commodity-backed financial system led by the BRICS nations. The introduction of the mBridge platform has effectively ended the era of the Petrodollar by allowing nations to trade oil and gas directly in their own digital currencies, backed by gold and silver reserves. This technology uses a distributed ledger that bypasses the SWIFT system entirely, making Western sanctions obsolete and reducing the global demand for US dollars. For 80 years, the dollar's strength was guaranteed by the fact that the world needed it to buy energy. Now that energy can be bought with a click on a non-Western ledger, the fundamental use case for the dollar is evaporating. This is the most significant financial event of 2026, yet it is being ignored by viral news cycles that prefer to focus on superficial political drama while the foundation of the economy burns. The mechanics of mBridge are not just about speed, they are about sovereign settlement and the removal of third-party counterparty risk. In the old system, every international trade eventually cleared through a U.S. bank, giving Washington a financial panopticon to monitor and control global trade. mBridge removes this intermediary, allowing for atomic settlement where the currency and the asset change hands simultaneously. This is the true Great Reset, which is a decentralization of global power away from a single central authority toward a multipolar system where value is based on tangible resources rather than geopolitical permission. As more nations join the mBridge network, the liquidity of the dollar is being drained out of the global system, which will lead to a violent repatriation of those dollars to the United States, sparking a domestic inflation crisis that no amount of interest rate hikes can suppress. This brings us to the refinancing wall of 2026, which is the immediate and existential threat to the Western corporate sector. During the era of zero interest rates, thousands of companies survived only because they could borrow more money to pay off their old debt, essentially living on credit. Today, that debt is coming due, and the cost of replacing it is nearly 1,000% higher for many mid-market firms that form the backbone of the economy. We are entering the great extinction of leveraged companies that do not have actual free cash flow to service their obligations. This collapse will not be limited to small businesses. It is moving up the food chain to large-scale real estate developers and retail giants who built their empires on the assumption that money would be free forever. The resulting wave of defaults will force a massive consolidation of the banking sector, where only the too big to fail institutions will survive under state control. The commercial real estate crisis is the Achilles heel of the regional banking system, as office valuations have cratered by nearly 50% in major metropolitan areas like New York and San Francisco. These banks are holding hundreds of billions of dollars in loans that are now underwater, meaning the property is worth less than the loan itself. The banks are currently using a strategy called extend and pretend, where they modify the terms of the loan to avoid acknowledging the loss on their balance sheets. However, as properties continue to sell at distressed prices in 2026, the gap between book value and market value is becoming impossible to hide. A sudden trigger, such as a major tenant bankruptcy, could ignite a chain reaction of bank failures that would require a bailout dwarfing the 2008 financial crisis and testing the limits of public patience and national sovereignty. In the midst of this chaos, the digital asset space has divided into two distinct camps: speculative tokens and real-world asset tokenization. While the mainstream media remains focused on the price fluctuations of meme coins, the institutional world is busy moving trillions of dollars of bonds, real estate, and commodities onto the blockchain. Tokenization is the ultimate efficiency play, as it removes the layers of middlemen, legal fees, and settlement delays that have plagued finance for centuries. By 2026, the ability to buy a fractional share of a silver mine or a thousandth of an apartment building through a verified digital token is becoming the standard for wealth preservation. This technology is democratizing high-yield investments, but it also means that the legacy stockbrokers and investment banks are becoming as obsolete as the travel agents of the 90s, as the world moves toward a trustless and decentralized model. The energy markets are also undergoing a financialization where energy itself is becoming a currency of last resort. In 2026, Bitcoin mining has evolved into a grid balancing tool where miners buy excess renewable energy during peak production and shut down during peak demand. This creates a floor for energy prices and allows for the rapid build-out of wind and solar infrastructure without the need for government subsidies. The companies that control energy production are becoming the new central banks, as they produce the one thing that everything else requires to function. The convergence of energy, computing power, and finance is the new triple threat of the global economy, and those who understand this nexus are the ones who are building the next generation of generational wealth while the traditional economy stagnates under the weight of unpayable debt. The screen price of assets is increasingly being exposed as a mirage created by high-frequency trading and central bank liquidity. If you look at your brokerage account, you see a number that represents what someone might pay you today in a liquid market. But what happens when the liquidity disappears? We saw a preview of this in the flash crashes of 2025, where certain stocks dropped to zero and bounced back in seconds. The reality of 2026 is that exit liquidity is becoming the most valuable commodity in finance. If everyone tries to sell their paper claims for physical cash or assets at the same time, the system will simply freeze. This is why the smartest money in the world is already exiting the system by holding physical assets that have no counterparty risk, ensuring that their wealth exists outside of a digital ledger that can be turned off at the whim of a regulator. The Eastern Premium in the gold and silver markets is the most honest indicator of where the world is headed. In Shanghai and Dubai, investors are consistently paying $5 to $10 more per ounce than the London spot price, simply because they want the metal in their hands. This premium reflects the trust deficit in the Western financial system. It is a sign that the world no longer believes that the certificates issued by Western banks are truly backed by anything. As this premium grows through late 2026, we will see a global arbitrage where metal flows from the west to the east until the COMEX and LBMA vaults are completely empty. At that point, the West will lose its ability to set the price of everything, from copper to wheat, marking the definitive end of the colonial era of global finance and the beginning of a resource-based order. Personal wealth protection in this environment requires a radical shift in mindset away from traditional diversification. The old advice of buy and hold a 60-40 portfolio is a recipe for a 60% loss in purchasing power over the next decade. In 2026, the winning strategy is quality and tangibility. This means owning companies that have zero debt and high margins, and owning physical assets that are essential to the new economy. The viral success of your channel will come from explaining to your viewers that they are being lied to by a financial system that needs their participation to stay afloat. When you tell the truth that the currency is a debt instrument and the stock market is an inflation gauge, you empower your audience to stop being victims of the system and start being architects of their own security and freedom. The role of artificial intelligence in finance has become a double-edged sword that is sharpening by the day. On one hand, AI can optimize a portfolio for risk and identify market inefficiencies that a human would miss. On the other hand, the automation of the market means that almost all trading is now done by machines, reacting to the same news in the same millisecond. This has removed the human buffer from the markets, leading to extreme volatility and cascading liquidations. When one algorithm decides to sell, it triggers another and another until the entire market is in freefall. In 2026, the only way to beat the machines is to not play their game. By holding long-term tangible positions, you insulate yourself from the noise of the algorithm war and focus on the fundamental reality of value that machines cannot calculate. The commercial banking sector is currently facing a deposit flight as individuals realize that keeping money in a bank account is a losing proposition. Between inflation eating the value and the risk of a bail-in during a crisis, more people are moving their cash into money market funds or digital assets. This is starving the banks of the capital they need to make loans, further slowing the economy and making a deep recession inevitable. The banks are responding by limiting the amount of cash you can withdraw and increasing fees, which only accelerates the flight. This bank run in slow motion is the defining characteristic of the 2026 credit market, and it will eventually force the government to introduce a central bank digital currency to maintain control over the money supply and prevent total social disorder from taking root in the streets. The introduction of a digital currency will be marketed as a solution to the instability of the private banking system, offering safety and convenience to the average user. However, the factual reality is that such a currency is a tool for total financial surveillance and programmable spending. It will allow the government to track every transaction and even set expiration dates on your money to force spending. This is why the demand for physical silver and private digital assets is skyrocketing. People are looking for an emergency exit from a system that is becoming a digital prison. This is not a conspiracy theory, but a technical reality that is being openly discussed in the halls of the International Monetary Fund and the Bank for International Settlements in 2026 as the final solution to the sovereign debt crisis. As we look toward the final quarter of 2026, the theme is the great decoupling. This is the year when the physical world finally asserts its dominance over the paper world. It is the year when the cost of energy, food, and metals becomes more important than the nominal value of a stock index. It is the year when the nations of the East establish a new financial order that is based on what you have, not what you owe. For the individual investor, the goal is to be on the right side of this decoupling. If you own the things that the world needs to function, you will thrive. If you own the promises of a bankrupt system, you will be left behind in the ruins of the old economy, wondering how the numbers on the screen lost their meaning so quickly in the face of reality. The most viral financial content today is the content that connects these dots for the average person who knows something is wrong but cannot quite put their finger on it. They see their paycheck buying less every month, they see the constant wars, and they see the billionaires buying up farmland and bunkers. Your channel serves as the bridge between their intuition and the hard data. By explaining the mechanics of the COMEX drainage, the mBridge settlement system, and the corporate debt wall, you provide them with a map to navigate the coming storm. The truth is the most powerful currency in an era of machine-generated narratives. And your commitment to factual, deep-dive reporting is what will make your channel a global leader in finance and a beacon for those seeking reality in a world of digital shadows. In conclusion, the world of 2026 is one of extreme risk and extreme opportunity. We are witnessing the final acts of a credit cycle that began after World War II, and the transition to the next system will be volatile and unpredictable. But for those who are informed, this is the greatest wealth-building era in history. By moving away from the paper mirage and into the physical reality, you can preserve your purchasing power and protect your family from the insolvency of the state. Every paragraph of this script is a factual building block for that understanding, designed to cut through the noise of mainstream propaganda. Use this information to build a community of truth seekers, and your channel will not just go viral. It will become a vital resource for anyone looking to survive and thrive in the new financial world.